The 14th of September, 2007. Newcastle, England. A queue of people stretches down the street, in front of a Northern Rock branch. It is raining. But nobody moves. They have been waiting for hours. They are not buying concert tickets. They are not waiting for a sale to open. They are waiting to take their money out of the bank. All of it. Before it runs out. Northern Rock was a respectable bank. It had been operating in Northeast England for 150 years. It had 1.5 million customers. And suddenly, within days, those customers panicked. The images went around the world. It was the first bank run in the United Kingdom in 150 years. Since Overend, Gurney and Company in 1866, no British bank had seen queues of depositors at the door. And the worst part, Northern Rock was only the appetizer. A year later, the global financial crisis would make the queues outside an English bank look like a minor problem. How is it possible that, after 300 years of central banking, centuries of regulation and deposit guarantee funds, people still fear losing their money in a bank? Because the system has a fragility that cannot be eliminated. Only managed. Throughout this season we have built, piece by piece, the banking system. From the Mesopotamian temples to the goldsmiths, from fractional reserve to money creation, from the Bank of England to the Federal Reserve. Today we close the season with the most uncomfortable question of all: what happens when the system fails? We are going to talk about bank runs. About panics. About deposit insurance and its paradoxes. And about shadow banking, the parallel system that operates without traditional banking regulation and that almost destroyed the world economy in 2008. A bank run is, in essence, a self-fulfilling prophecy. Remember what we saw in episode 4. A bank with fractional reserve has, at any given moment, only a fraction of its depositors' money. The rest has been lent. If all depositors come to withdraw at once, the bank cannot pay. That does not mean the bank is bad or dishonest. It means the system is designed to work with trust. As long as trust holds, there is no problem. When it breaks, the system collapses. How does a run start? With a rumor. With a news story. With the suspicion, justified or not, that the bank has problems. If enough depositors believe the bank might fail, they rush to withdraw their money. And by withdrawing, they cause exactly what they feared. Picture it like this. The bank has deposits worth 1 billion euros. But only 100 million in liquid reserves. The rest is in mortgages, business loans, long-term bonds. If tomorrow depositors come to claim 200 million, the bank does not have it. Not because it is insolvent, its assets are worth more than its liabilities, but because it cannot convert a 30-year mortgage into cash overnight. It is the difference between illiquidity and insolvency that we mentioned when we discussed Bagehot. And it is the difference that, in practice, becomes almost impossible to measure when everyone is panicking. The history of banking is, in part, the history of its panics. The Panic of 1907, which we already covered, is a classic case. A failed attempt to manipulate the market triggers a cascade of failures. Depositors rush to withdraw. J.P. Morgan saves the system from his library. The immediate lesson: a central bank is needed. But even with a central bank, runs did not disappear. The Great Depression, between 1929 and 1933, was devastating. In the United States, more than 9,000 banks failed. 9,000. Depositors lost billions of dollars in savings. Families who had worked their entire lives watched their savings vanish overnight. Why did the Federal Reserve not prevent it? That is one of the most debated questions in economic history. According to Milton Friedman and Anna Schwartz, in their masterwork A Monetary History of the United States, the Fed made a catastrophic mistake. It did not act as lender of last resort. It did not lend freely. It did not follow Bagehot's rule. It let banks fail one after another, turning a severe recession into the worst economic crisis of the 20th century. President Roosevelt's response was drastic. In March 1933, he declared a bank holiday. He closed every bank in the country. All of them. For several days, no American could access their money. Only the banks deemed solvent were allowed to reopen. And in June 1933, Roosevelt signed the law that created the FDIC, the Federal Deposit Insurance Corporation. An idea that would change banking forever. The idea is simple. If your bank fails, the government returns your money. Up to a limit. In the United States, the FDIC guarantees up to $250,000 per depositor per bank. In Europe, the Deposit Guarantee Scheme covers up to 100,000 euros. In Spain, the system works the same way. If your bank fails, you recover up to 100,000 euros. The effect is immediate and powerful. If you know your money is guaranteed, you have no reason to rush to the bank at the first rumor. And if nobody rushes, there is no run. Deposit insurance does not only protect after the disaster, it prevents the disaster from happening. After the creation of the FDIC, bank runs practically disappeared from the United States for decades. The system worked. But there is a catch. And it is called moral hazard. If depositors know they will get their money back no matter what, they stop worrying about the soundness of their bank. Why bother investigating whether your bank is prudent or reckless, if you are going to get your 100,000 euros back anyway? And if banks know that depositors are not going to withdraw their money because they are covered by insurance, they can take more risks. They can lend to riskier clients. They can invest in more volatile assets. Because if things go well, they keep the profits. And if things go badly, the guarantee fund, that is, the taxpayers, pays the bill. Deposit insurance reduces the risk of bank runs. But it increases the risk that banks will behave recklessly. It is a solution that creates a new problem. There is no perfect answer. Regulators try to compensate for moral hazard with more supervision, more capital requirements, more rules. But it is a permanent race between regulators who set rules and bankers who find ways to get around them. And here we arrive at the most recent and perhaps the most unsettling chapter of this story. From the 1970s and 80s onwards, the financial system began to change. Alongside traditional banks, those that accept deposits, make loans, and are regulated, a parallel system emerged. Investment funds, money market funds, structured investment vehicles, repo markets, very short-term loans between financial institutions. This system is known as shadow banking. Not because it is illegal, but because it operates outside traditional banking regulation. It does not accept deposits from ordinary citizens. It is not covered by deposit insurance. And for a long time, nobody paid it much attention. But shadow banking was doing essentially the same thing as banks, transforming short-term money into long-term investments. Money market funds received money from investors who could withdraw it at any time, like a deposit, and invested it in longer-term assets, like a loan. It is the same structure as fractional reserve. And therefore, it is vulnerable to the same problem, the run. In 2008, that is exactly what happened. It was not a run of citizens queuing at a bank. It was a run of financial institutions withdrawing money from repo markets and money market funds. In a matter of days, trillions of dollars evaporated from the system. The Deposit Guarantee Fund covered none of this. Because technically these were not deposits. They were investments. But they functioned exactly the same way. The result was the most severe financial crisis since the Great Depression. Investment banks like Lehman Brothers went bankrupt. Governments around the world had to rescue financial institutions with public money. Millions of people lost their jobs, their homes, and their savings. The lesson was brutal. You can regulate banks as much as you want. But if a parallel system, unregulated, uninsured, grows large enough, it can destroy the economy just like a traditional bank run. And that is exactly what happened. Let us return to Northern Rock, which we began this episode with. Because its story perfectly illustrates how the problems of modern banking are, at their core, the same problems as always. Northern Rock was not a reckless bank in the classic sense. It had not made loans to people who clearly could not repay, at least, not more than other banks. Its problem was different, how it funded itself. A traditional bank funds itself mainly with customer deposits. People's money. That is stable. People do not usually withdraw everything at once, especially if there is deposit insurance. Northern Rock, by contrast, funded itself largely in wholesale markets. It borrowed from other banks and financial institutions, short-term, and used that money to grant long-term mortgages. It was cheaper than relying on customer deposits. But it was also much more fragile. When the subprime mortgage crisis in the United States shook financial markets in the summer of 2007, banks stopped lending to each other. The interbank market froze. And Northern Rock, which depended on that market, ran out of funding. In September 2007, the bank asked the Bank of England for emergency help. The news leaked to the press. And depositors, who were not the cause of the problem but its potential victims, rushed to take out their money. It was the first visible bank run in the United Kingdom since 1866. The queues stretched around the block. The government ended up nationalizing the bank in February 2008. Northern Rock is a story that combines all the themes of this season. Fractional reserve. Dependence on trust. Shadow banking as a funding source. And the inherent fragility of a system where short-term money finances long-term investments. In 2008, families around the world lost their homes. Not because they had done anything wrong, but because a complex, interconnected, and partially unregulated financial system collapsed. A bricklayer in Spain who had taken out a mortgage in 2005 knew nothing about repos, synthetic CDOs, shadow banking, or Lehman Brothers. But when the system came crashing down, he lost his job. He could no longer pay the mortgage. He lost his home. And for years, he carried a debt that exceeded the value of the flat that had been taken from him. Banking is not an abstract topic. The decisions made in bank boardrooms, in central bank meetings, in derivatives markets, those decisions directly affect the lives of millions of people who have never heard of those markets. Understanding how the system works will not protect you from the next crisis. But it will help you understand why it happens. And in a democracy, understanding is the first step towards demanding that things be done better. 5 key ideas from this episode. First, bank runs are self-fulfilling prophecies. If enough people believe a bank is going to fail, they withdraw their money and cause exactly what they feared. Fractional reserve makes banks inherently vulnerable to this phenomenon. Second, the Great Depression saw the failure of more than 9,000 banks in the United States. The response was the creation of the FDIC in 1933, a deposit insurance scheme that guarantees savers money up to a limit. Third, deposit insurance prevents runs, but creates moral hazard. Depositors stop monitoring their banks, and banks can take more risks knowing insurance will cover the damage. Fourth, shadow banking, investment funds, repo markets, structured investment vehicles operates outside banking regulation but replicates the same structure as fractional reserve. Its collapse was the main cause of the 2008 crisis. Fifth, Northern Rock showed that the problems of modern banking are, at their core, the same as always, transforming short-term money into long-term investments, and depending on trust not breaking. We have come a long way. We began this season in the temples of Mesopotamia. We saw how priests stored grain and lent seeds. We saw the Templars invent international banking. The Medici perfect accounting. The goldsmiths discover fractional reserve. We saw how banks create money out of nothing. How central banks were born. And how, despite everything, crises keep happening. The thread running through it all has always been the same: trust. Banking works when people trust. And it crumbles when that trust breaks. But there are two forces that shape that trust more than any other. Two forces that affect every family, every business, every government on the planet. Every day. The first is the price of money, interest rates. How much it costs to borrow. How much you earn by saving. The second is the price of everything else, inflation. Why things cost more each year. What happens when prices rise too fast? Or when they stop rising and start falling? Banks create money through loans. But those loans have a price: interest. And when too much money is created, something else happens: prices start to rise. Interest, debt, and inflation. The three forces that govern the modern economy. That is what comes in Season 4. That is where we are heading.